Well, the most obvious long-term impact that we see with the negative interest rate environment is the damage that it can do to bank profitability. And we shouldn't forget that the overriding objective of monetary policy at the moment is to increase the flow of lending, increase the flow of credit into the economy. My fear is that if we went into a prolonged period of negative interest rates, the damage or that could do to the capital base of the banks would, in fact, achieve quite the opposite, and the flow of credit to the economy could shrink. Now, there are ways to mitigate this, but it would need us quite a significant overhaul of the infrastructure in order to offset some of these negative effects.
And Dean, of course, we have evidence from others who have gone down that path as well. So we're not necessarily in the dark in terms of searching for what happens. Is all they can rely on when they tout the benefits of negative rates the counterfactual? Because that's all I can hear. Oh, but if we hadn't have done it, look what would have happened.
Yes, I mean that's a good point, and when we're thinking about what could have happened, I'd also think about the counterfactual of what would have happened if interest rates weren't negative and other schemes were used in order to lower the borrowing rates in the economy, and there are other effective ways to do this. The Federal Reserve has managed to get through two crises now. Well, not quite get through the second, but we're still in the second crisis without venturing down that route. And it would be my view that the Bank of England should stay firm and stick to a policy of avoiding negative interest rates. The other concern I have with negative interest rates as well is they're very attractive sounding in the short term, but nobody ever thinks that going into a negative interest rate is going to last forever. But as we've learned with the ECB and the BOJ, once you're there, it's extremely difficult to get out of.